Hello, and welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Square Communications. Each episode we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Mitesh Sheth, founder of OrgAlpha and ex-CEO of Reddington, to the show. Welcome to the show, Mitesh.
Oh, it's great to be here. Thanks for having me.
Yeah, it's great for us both to be here. We've just had an hour of technical difficulties, haven't we? So we hope you all appreciate us being on the show. But do tell us, Mitesh, what is your news story of the week?
Okay, well, second time lucky. My news story of the week is particularly coming in after half term. Was the FT's weekly asset management newsletter. And I think the thing that caught my attention was really their concerns that they were raising about private equity and private credit.
Yeah, I think that's really interesting. But what was it in particular that grabbed your attention? Because we've heard quite a lot about private credit and private equity perhaps not doing as well as it has done in the past.
Yeah, I mean, I think when I'm reading articles and or attending conferences, I just feel like so much of the debate is tilted towards either asset managers saying they need to get these into kind of DC and wealth portfolios, or asset owners and others thinking about how they can do that. And I just don't feel like the risks and the benefits are kind of weighed fairly enough and in a balanced way. And so I was really pleased that this article kind of wasn't giving a view either way, but was raising kind of really clear thoughts and concerns, and kind of, for me, highlighting the need for better due diligence. And I think that's what really caught my attention, and I was pleased to see.
Yeah, I mean, it's interesting if you think about it. It's always struck me as kind of the dog that hasn't barked, if you think about it. If you go from 1% to 4%, 4% might not seem that high an interest rate, but it's still quadruple what it used to be before, and that's got to have an impact on a company's cash flow and balance sheet, and of course its P&L. And so I found it quite strange that we've had this very relaxed, steady state with limited amounts of bankruptcy. So how has that happened? How have we not really felt the massive change in interest rates on company balance sheets?
Yeah, so I think companies were in pretty good shape post-COVID and had good amounts of kind of cash and liquidity. I think in 2022, when we saw the significant rise in rates, there's usually a delayed transmission mechanism anyway. And so I think the big refinancing kind of wall of debt was kind of 25, 26, 27, so coming up now. But in that interim, we have seen, obviously, a much bigger private credit market that's providing this financing. And that market is exploring all sorts of things, from kind of switching debt for equity all the way through to allowing companies to not pay their interest payments until they need to pay back their debt. And in some ways, that's a great thing because it allows patience and it supports companies when cash flow is challenged. But I think the real concern is if we don't see lower rates and return to growth, then what we're really doing is kind of massaging or hiding these defaults that would have otherwise happened. So it is a new environment, and this hasn't been tested.
Yeah, and if you say everybody's kind of like roll forward everything, I mean, one day it's all got to come due. Does that make it worse in a way? Because do we get a huge lump of everything happening all at once, whereas it might have trickled out over time before?
Potentially, and I think that's why you're starting to see these concerns rise, particularly over the last month. I'm starting to see a string of kind of events and articles, and I think you're starting to see these concerns as we hit that wall of refinancing. And I think the concern is obviously pre-financial crisis. We were looking at the banks. The banks have been heavily regulated, but the private credit markets are much more illiquid, but also much less visible, much less transparent. And so it's the lack of visibility that I think is causing concern there.
And on private equity, is it a different concern that's driving that? Obviously, it's not about credit ratings per se, because it is obviously equity. I've heard a lot about the fact that we have a lot of dry powder and people like struggling to exit. What's really driving the concerns there?
Yeah, so I think we've been hearing, at least in hushed corridors from asset owners over the last couple of years, that they're concerned they may have too much by way of private equity exposure and an inability to rebalance that to a more neutral weight. I think what the article that I read this morning that was pointing at was just really how the power has shifted from these big global private equity companies over the last decade to really the asset owners. And in this particular article, that was a little humorous in moments, it was kind of saying how the lawyers were being asked to change how they communicate and be less aggressive. And it's just it was quite funny how I think there was this image of a word cloud at this private equity conference where asset owners had said fire the lawyers, which was, I wish I was in the room. But
I like the idea of lawyers being less aggressive. Lawyers live to be aggressive. They live to fight and to win fights, don't they?
Particularly private equity lawyers, right? And so I think what the article is pointing to is how they're running communication workshops because because the asset owners really have got the power here. And in this environment, they're the ones saying, well, we're not going to achieve our returns unless we see lower fees, more transparency, and ability to manage that liquidity and so on. So I think, again, a healthy sign and shift. But actually, again, for the first time, I'm seeing that get into the public narrative and the broader narrative to say, stop thinking about these as generic asset classes. And yeah, in a very benign environment where rates were low for a very long time, where credit was cheap, we could make allocations, and it was very hard to not do well.
Yeah, well, I mean, that's the point, isn't it? And I mean, we've seen in the UK, when it comes to sort of government policy and the whole of the UK is littered with examples of sort of private equity that went wrong, where that old-fashioned style of get in and then just laden the companies with debt in order to sort of extract maximum value and then exit, leaving it sort of a smoking mess, just isn't going to work anymore in higher interest rate environments. That's number one. Number two, you're going to have to sort of get to what private equity is supposed to be, which is moving away from financial engineering and towards, management consultancy of putting your money where your mouth is. You actually go into a company and make it better and make it build and bringing the expertise. And I'm not sure, maybe I'm being cynical here, but I'm not sure we have many great examples of that. And as you say, it's case by case. So
look, I think you're spot on. I think it really is a matter of, there are some great firms that have, one, really good due diligence on one side, two, are really working, either being hands off and letting great management do what they do and providing them with the support and financing, or indeed getting involved where they need to. And it's not, just a debt laden strategy that was designed for a different decade. But I think that due diligence is so important. I get really nervous when I start to see the push for DC or the push for wealth to get into private assets beyond just the illiquidity and the complexity. It's like, you should never do anything when everybody's doing it. When my mother-in-law started to talk to me about buying Vodafone in 2000, I kind of started to suspect this was this was potentially the peak of the dot-com bubble. So that concerns me, and I want to see more dialogue of what are we trying to achieve, what role can these assets play, what skills do we have to actually be able to discern good from bad, and when's the right timing, which part of the universe. And I think that's so much more important than thinking in these rudimentary asset management asset class building blocks.
So let's bring it back up to pension schemes, because I mean an ex-investment analyst to me is loving all of this talk of down and dirty in the asset classes. But if we go back up to sort of like the pension schemes, what does it mean what are you saying for how they approach this? Because from what you're saying to me there, it sounds to me like you are sort of presenting an activist approach, that you're saying an asset class as an asset class is neither good nor bad. It's like a curate's eggs, there are good parts and there are bad parts, if that's the expression. I can't remember curate's egg mean now, but you're saying that sure there's great private equity, sure there's great private credit, but you have to know what you're investing in. So is it an activist approach that you're saying that pension schemes should adopt, or is it something more than that?
I think you're spot on. I think whether it's private assets, frankly, whether it's public equities or public fixed income, real estate or otherwise, there are real areas of potential bubble and expensive concerned areas versus those where there's kind of tons of opportunity. And I think the macro regime we're in is only going to create further distance between winners and losers. Mm-hmm. And so I believe that we are well past a market regime where you were thinking in these asset class buckets of, well, what is my equity fixed income or my equity credit liquid public private mix? And I hold that over the long run and then outsource that to asset managers, what was called strategic asset allocation. And I think it's kind of not surprising you're starting to see a lot of movement away from that towards something that is kind of being called total portfolio approach, TPA, but really is how great multi-asset portfolios manage money. They're not just playing with these very rudimentary building blocks. They're thinking about the underlying regions and geographies and sectors and really thinking about how those sit across the risk of the total portfolio, not just delegated to different specialists that aren't aligned and aren't looking at the bigger picture. And funnily enough, actually, just this last month, we've seen quite a lot of research and case studies being shown by Kaya and the Thinking Ahead Institute around translating TPA into practice. Like, what are the steps? What are the challenges? What are the case studies they're seeing from asset owners doing this? So it is a different mindset and approach that's needed in this market regime.
Well, that's really interesting. So when we think about the pension schemes and we think about the four pots of capital, so if we think about closed DB, open DB, DC, and then insurers, which I think is part of the occupational pension scheme with the buyout, how much can we apply that TPA approach? Does it only really apply to open and DC because closed is in such a specific game? It's quasi-insurance led, and insurance is in such a specific game as well because it's so locked down by regulation that it's all in fixed income. Or can you take a TPA approach even if you are, for a DB scheme, massively invested in LDI with a tiny bit of growth, or if you are an insurer and you have to have everything in fixed income? Or does it only really sing for DC and open DB?
So in my experience, TPA is a spectrum rather than one destination, and asset owners sit all along it, and it's really just begun and gaining momentum over the past few years in that form. I think it's relevant to all because TPA really starts with the goal and what outcome do we want for members, and its heart is joined up risk management, joined up stewardship, joined up reporting and thinking across the totality rather than in silos. And so whether in a DB scheme, you've got your cash flow matching LDI, and maybe with your surpluses, you're thinking about what to do, or you're trying to narrow your route, whether to self-sufficiency or buyout, you're still in a market regime that is more volatile, that has more dispersion, that has more tail risks than we've seen, where the historical models aren't necessarily playing out as we are experiencing, where you need to think about risk in a joined up way, all the way through to DC or charities or elsewhere where you've got more of a growth orientation. So whether you're trying to better diversify and manage your risks, or whether you're trying to achieve better real returns, I think a TPA mindset, not necessarily just a singular approach, but thinking more joined up across asset classes and really thinking about risk in a joined up way with potential future scenarios that we can't possibly know and predict and our models haven't experienced, I think is going to be really key to asset owners being able to deliver target returns, manage risk, deliver the cash flows and liquidity for underlying members. So I think it's a really critical shift away from a very static set and forget approach.
Yeah, and as you say, thinking of your portfolio of a series of building blocks, and it's just about how big that building block is, and I'm just going to buy a passive building block. I'm just going to buy the MSCI World, and I'm just going to stick it in my DC portfolio, and that's it. Or maybe I'm going to do a climate tilted MSCI World, and I'm going to stick it in my portfolio, and that's it. And I mean, I think it's really interesting what we've seen Master Trust begin to say right now. If we think about Master Trust or sort of DC generally, not just specifically Master Trust. But if you think about the DC world at the moment, I think in a way that's kind of the most interesting thing that's going on if we're talking about from a pure juicy investment perspective, and we're always here for the juicy investment perspective here at the Professional Investment Podcast. If you think about it, it's just such an interesting sort of cuspy time for them, because they're just beginning to enter into this time where they're going to be starting talking about retirement income. We saw that at Pensions UK in Manchester, massive interest, lots and lots of people, and in a way retirement income is quite straightforward in that you need some probably global corporate credit, which is going to give you some decent yields. But to go back to your point, maybe that's a bit questionable if we're just on this phase where global credit, we might have some blow-ups happening, and maybe we need to do our global credit in a more intelligent way than just, say, a passive global credit fund, because DC has been very in favour of the passive approach. And if we look at it from the wealth accumulation size, it's, as you say, it's giving yourself possibility to be more dynamic, if that's the right phrase, even if you're doing within a passive constraint.
Yeah, I think you raise a really interesting point there. And I think about, again, if you were retiring in 2022, at the and you were safely, supposedly landing in a bond or a corporate bond portfolio, you wouldn't have been too happy with how your portfolio was doing, right? The reality is, firstly, that those retiring today or in the near future may have different needs in retirement. And so income is one of those. And it may be intergenerational wealth transfer. It may be something else. And maybe we're still 10 years away from people not just relying fully on their DC pot and not a blend of their DC, DB and other things, right? So I think that's one part of it that you're starting to see innovation around. But I think the other bit is actually income is available through lots of different strategies and asset classes. And actually in a environment that is rebuilding post some kind of crash, post some kind of bubble bursting, everything from equity income to other parts of the income kind of universe can be quite resilient companies. And so again, here for me, this is not about equities, bonds, or bonds, government bonds and credit, but it's really thinking about what is our end beneficiary want, need, and understanding that, listening to them. And secondly, thinking about, in the multitude of market regimes we may face, how might we best build that portfolio with much more nuanced building blocks, and critically, how do we recognize that we might be wrong and have hedges and parts of our portfolio that will do well if our forecasts are wrong, and diversified along that. And I think that's really the mindset shift, and it's a bit of a cultural change. And beyond the the consolidation of whether master trusts or in DB or elsewhere, even asset managers, I think that the need for joined up thinking and communication and really listening to clients and really acknowledging what you don't know and building portfolios that are resilient, I think is going to be key.
Yeah, I mean, if we think about it from the DC mindset, one of the kind of the concerns people are talking about now is this, as the FT put it a few weeks ago, the US economy is a one-way bet on AI. And as we know with technology, sometimes it works, sometimes it doesn't work, sometimes it doesn't, sometimes it takes a lot longer to work. Almost always it takes longer to work than you think.
It's been a good bet to have. The question is, what's the right size?
Exactly,
And
and
if it unwinds, and if it and if it falls off an edge, how much can I afford to lose? And that's the heart of investing our end beneficiaries' money, surely.
yeah, and we've seen, so the master trusts have taken different approaches. Nest was doing an event with me a few months ago, and they were talking about how they've started to actually give a sort of thematic active allocation to equities as sort of counterbalance, because they are concerned about, this passive exposure that's just going to follow the bubble, possibly all the way up and then all the way down. And then other master trusts like People Pension have got this sort of dynamic idea where you can shift between different regions that you referred before. So people, I think, within our space are already beginning to think in a sort of a TPA mindset. Obviously, it has a lot further to go, and those are the two sort of big, most sophisticated master trusts. I don't know how that trickles down to the rest of the universe, and we always have this constant sort of dynamic within DC against sort of like where do you go in terms of fees, and cost has really been a way to gain market share, and the government is really pushing the consolidation agenda, which is likely to push that cost agenda a bit further, at least for several more years. So there's a really interesting push-pull between different sort of policy objectives and different objectives from both the providers themselves and the government. So yeah, it's going to be a very interesting one to watch.
Yeah, and I think costs are going to be critical. And where we started right at the beginning is, do we need a more active, dynamic approach in these markets? I think most asset owners suspect they do. And then you come to the question of, well, how do we do that in an affordable way? And maybe there are betas in our portfolio that can be run passively. But there needs to be part of our portfolios where we can be flexible, where we can be dynamic, and critically so as we start to think about private assets and alternatives. The thing that for me misses quite a lot are liquid alternatives. And when people go, you've got your balanced equity bond portfolio and they're jumping straight to private credit and private equity without really thinking about this whole universe of more liquid alternatives where you can be wrong, can change your mind, can gradually ease into, lock up illiquid assets at the right time and at the right price. And so I think there's a lot of thinking work and innovation to do. I'm really pleased some of the bigger ones thinking and leading the way there.
And what is it that's really driving this kind of switch towards a more TPA approach? Is it just because we're entering this period where, it's something quite simple, really, has worked for an awfully long time, just by US equities. and then people are concerned about where that's going to end. Is it about the rise of geopolitical risk? Is it about people becoming more sophisticated? What's really driving that, do you think?
Yeah, I think a few things. I think one, more geopolitical risk and uncertainty and a shift away from globalization, kind of after, 40 odd years, to higher rates and inflation, or at least more volatile rates and inflation, and how asset classes kind of perform in that. Three, I think larger, more sophisticated asset owners, as consolidation continues, asking themselves, what should we run in-house? What do we need of our asset manager partners? Do we need as many? And I think four, I hear from a lot of asset owners that we've outsourced to a lot of parts of our portfolio and spend a huge amount of time reviewing asset managers against their very narrow mandate. Whereas what we're missing is the question of where, not just how much should we have in equities, and then within my North America sleeve, which managers do I have, but how much should I have in North America, and how much should I have in tech, and where else can I diversify that? And does that all need to be in equities? And how does my credit portfolio likely correlate with that? What have I got in my real estate portfolio or in my infrastructure and otherwise? And I think that need, both from a risk management, as people keep seeing everything correlate to one, as well as from a need for higher real returns. I think those are a number of things that's driving this change. And as I say, look, good multi-asset managers, like before I was at Newton, at Henderson, at Reddington, at Newton most recently, like great multi-asset portfolio managers that I've managed and kind of clients we've looked after haven't wanted us to just be allocating to equity bonds and alternatives. It's been really finding the themes, really figuring out the companies that are going to be successful and managing a broader, diversified portfolio and really thinking about that in a joined up way. So I think this is just good investment management. And I think it's critical in the kind of uncertainty that we're facing.
And I just wonder, because, you know, you and I have discussed offline many, many times all of the changes that are facing the whole investment chain. I mean, I've expressed to you that I think there have been three massive changes. You've had a massive change over the past 20 years in how occupational pensions are delivered in the UK, from the death of DB to the birth of DC. We've had, I mean, financial market uncertainty, as Toby Nangle will say, is a continuous thing, but we really did see a sort of real change around the global financial crisis. And then from the asset management perspective, we've had this massive change in the competitive landscape as well, with passive managers eating the lunch of active managers and everybody facing fee pressure. So these are three really big, significant trends for everybody in the marketplace to get their head around. And now what you're saying is there's the kind of like an amalgamation of the sort of the middle one, the markety bit, that's coming to the fore for the future, which is like, well, you think you know how to design a portfolio, but you don't. You need to start thinking about that. So what are the implications for everybody in the investment chain that's kind of like scrambling to catch up with all of the change at the moment, and you're just signalling a whole raft of new changes? What would you advise?
Well, that feels like a really nice setup, but I promise it wasn't premeditated. I mean, I have left, I guess, corporate leadership roles in asset management, in investment consulting, really with a view of saying, I think this is one of the most interesting times across the industry, and the industry almost needs to redesign itself. And it's figuring out, how do we collaborate across the asset management piece, across the asset owner piece, and when we, how will we redesign those connections and those relationships? And I think for me right now, I'm really enjoying having that broad dialogue across asset owners around the world that are trying to learn from each other's mistakes as well as successes. And as they're consolidating and getting bigger and building investment organizations, asking, how do we design for the next few decades, not the last few decades? And then you've got asset managers going, well, if there isn't going to be 30, 50 narrow niche mandates being allocated off a traditional SAA model, and if even on the margin, there's going to be fewer strategic relationships, what does that mean for us? Does that mean we've got to become, like a BlackRock or a JP Morgan? Or is there space for those in the middle, those with a niche expertise? And critically, how do we go from, our sales process beginning when we see a tender or an RFP and pitch for a mandate, to a more strategic relationship where we're bringing our whole organization to our asset owner partners in how they think about tech and AI, in how they build an investment culture, how they use quants, and all the way through to the specific kind of mandate. How do we become an extension of their team? That's such a major rewiring. And I think it's fascinating. It's what I'm spending most of my time talking to clients and prospects about. And again, I've been really pleased and excited with how keen people are to explore that and determined to do something, not just talk.
Yeah, well, I mean, at the end of the day, if you keep trying to do the same thing and it doesn't work, so if you keep cutting headcount and the flows still aren't flowing and your profit margins aren't improving, at some stage you've got to realise that old expression that, to do the same thing and expect a different outcome is the definition of insanity. So from both OrgAlpha and More Squared Communications, I think this is a great opportunity for both of us to work with people who are interested in taking a different approach and understand the risk in staying the same way, and thinking about, I don't know, crazy idea, maybe you want to build a sort of a better client connection and deeper relationships. So there you've got a shameless plug from both of us if you've listened this far.
What I've loved about talking, I mean, we've really only got to know each other over the recent months, and what I've really found critical is, and if I had to, close with a takeaway, it would be like actually go listen to your clients, and not just the equity or bond or real asset allocator, but to the CIOs and the CEOs, and understand the multitude of pressures they're under and how they're thinking about redesigning their internal governance and how that will connect with the industry, what they need from the industry, to then play back and story tell and figure out how you meet that. And I think you guys at More Squared are doing a phenomenal job of helping asset managers actually listen to their clients and begin their strategy by understanding what they need. So yeah,
we're going to stop there before we have to start passing out vomit bags to our listeners. But I would say, though, the one thing I would say is that is the tremendous privilege of having been a journalist for 20 years, is that even though you're on the outside, you're actually more on the inside than people on the inside, because you talk to everybody and because you talk up and down and because people tell you everything. And you always know who the good journalists are, because we don't tell everybody everything that everyone tells us. So we just keep it, and we build up that knowledge in sort of like archaeological layers. And that is something I really, really enjoyed about the past 2 decades, and still doing, still writing, still being a journalist and doing this podcast is really just adding all the time to your knowledge of a really complex and interesting sector.
And I think it is a really valuable skill set more than ever. That joined up system thinking is critical more than ever. And I think there are few that have that perspective. So many have such a narrow, siloed perspective of their asset class or their firm or their little niche of the industry.
Well, as I said, we better end it there before we have to send out vomit bags to our listeners. Thank you so much, Mitesh, for persevering with me whilst I tried multiple platforms.
We got there.
Multiple computers. We got there. And we're still going to put the podcast out when we said we're going to put the podcast out. Thanks very much for sharing your insights on your news story of the week. Listeners, I really hope you've enjoyed this episode. Make sure you hit the subscribe button so you never miss a future episode of the Professional Investment Podcast. Do engage with us. If you're listening on Spotify, take part in the poll and do comment. Thank you so much for listening.
Thank you.